Today I wanted to, our class topic is just the basics of mortgage loans, but this is not just a mortgage 101 class. I just want to explain some of the basics, but feel free to ask me to elaborate on any of them as we go. I don't think I have the ability. Maybe I have the ability, but I don't have the know-how to share screen with you guys. So I apologize for that, but there is a playback of this class on my YouTube channel. My YouTube channel is Michelle Castle. If you go to playlist, there's a playlist for the success series, so you can get any of the classes that I've already taught. And any of the classes that I've taught in the past are also on YouTube. And then we'll also send out the PowerPoint and handouts for the class itself. So you guys are old-fashioned, keep notes, ask questions as we go so that you don't have to worry about remembering that question. But understanding the mortgage basics. So here's the 4 basics that we're going to cover. You have a conforming conventional loan. Now, a conforming conventional loan is just your standard plain traditional mortgage loan. Then you have your non-conforming conventional loan, and your non-conforming conventional loan is investors that have pooled their money together, or financial institutions that have put a loan program together specifically targeting a type of market. And then you have your government loans like FHA, VA, and then of course your USDA. USDA is actually considered a non-conforming conventional loan, as odd as that is. Fortunately, with Texas, our promulgated contracts finally, a couple of years ago, spelled out USDA separate as a type of loan. Prior to that, it was really confusing about what box you were supposed to check on your USDA loans. So the common terms, now this is really important, and I know that these sound like basic terms, but they're really not whenever you know and understand, especially with the contracts and the appraisals that we're seeing now in this current market. The down payment on a transaction. So if you're page 1 of the contract, the down payment is literally it's going to be based on the purchase price or the appraised value. But when you're writing the contract, all you know at that point is the purchase price. So your down payment calculations, your 10% down, your 15% down, whatever it is based on the is based on the purchase price at that time. Debt to income ratios is another term that you'll hear, and your mortgage loan approval is based on a debt to income ratio. So a debt to income ratio, we're literally taking all of their monthly liabilities, their obligations for their debts, the monthly payment for those obligations, divided by their gross monthly income. Now, we've talked about this in classes before. The debt that we're counting is child support because it's a legal obligation. You have your installment loans, student loans, which is a really hard payment to calculate because every loan program, and even within the loan programs, the agencies within that loan program calculate student loan payments differently. So that's a little bit harder payment to calculate because a lot of people have deferred loans or they have income-based repayment that does not pay that student loan off. It just gives them a reduction in their payment for a certain period of time based on their income. So, but you also have your minimum payment on revolving debt that gets counted in there, any kind of outstanding line of credit. In our area, the other payments that or debts that we often see is like a farmer will go to a bank and they'll borrow money on a one-pay interest-only loan for farm equipment. And those don't typically have payments. So each loan program has its own requirement as to how you calculate the payment for that so that we can calculate the income. Now, the other thing that we talked about is the differences in the different loan programs and how they calculate the qualifying income. The qualifying income is always based on gross, so before taxes. But the qualifying part changes from loan program to loan program because they all require different calculation in terms of overtime, bonus, commission, average. You average it over 1 year or 2 year, depending on the loan program. So once we have all of that information and we know what loan program we think that is going to be best for them or the loan options we are going to present to them, then we can calculate the debt to income. Reserves is another word that you're going to hear often, and that's just literally the amount of money left over at the end of closing. Why this matters to you right now in this crazy market that we're in is because let's just say that someone makes an offer on a house that's $250,000. Their down payment is going to be 10% based on that sales price, but they're having to pay $275,000 for that house. Right now, I'm telling folks it's not unusual to pay 10% over list price to get the offer, especially if you're competing against cash. So their down payment is going to be based on that $250,000. So 10% of the $250,000, plus they're going to have to write a check for the difference if the house does not appraise for over $250,000. Now, how you guys address that in the contract to protect your seller is between you and your broker. There's a couple different schools of thoughts, and I just had a conversation with another realtor about how you guys are handling those conversations. But your question to the lender is, before you negotiate the contract, you need to call all of the lenders and ask the lenders, does the buyer have the ability to write a check for the difference in the event that the house only appraises for the list price? And if they do have the ability to write a check, do they still have the reserves left to get the loan approved? Because there are some loans where if the customer scraped the bottom of the barrel and wrote a cashier's check for every penny they had in their bank account to cover the difference and the down payment and the closing costs and the taxes and insurance, they have zero reserves left, and now you can no longer get a loan approved. So you guys need to be very specific with your question, but you need to know and understand that reserves oftentimes are required for the loan to get approved. And you want to make sure that the buyer has the ability to write that check. The credit score. The credit score is, hey, BJ, I don't know if you're watching the Teams chat, but Ben's having a hard time getting logged into Zoom. If you can help him out. The credit score is, oh my gosh, we could talk about this all day long because people get often confused about why. Just yesterday, we had a conversation with someone who had a credit score of 800 on Credit Karma. We pull their score and it's 701. And they get flustered because the credit scores are not the same. Well, when you look at the difference, keep in mind, credit scores are determined, each credit monitoring service, whether it be your Discover credit card, Credit Karma, MyFICO, whatever it is, they all have different scoring systems based on the information that was pulled at the time that credit report was pulled. So the credit score could and is likely going to be different depending on who pulls the credit report. But if I pull a credit report today and someone calls another mortgage lender to pull a credit report today, as long as the information is exactly the same, the score should be too. What would make it different is if I pulled a credit report today and then they paid down some credit cards and those credit card balances are lower and they call Tanya at First United and Tanya pulls a credit report, her scores could be possibly higher than mine because of the credit card being paid down. So if there's any variance in the credit score, it's because the information has changed from lender to lender, not that the lender's credit scoring system is different. But our scoring system is different than the consumer credit scores or the scores that you get at a dealership. So that part can be very frustrating. Every bit of what I'm talking about, if you go to my website, michellecastle.com, there is education on all of this, and you could save those links when your customers get frustrated and say, hey, it's confusing to me too. I totally understand your frustration. Here's a link that better explains why that has happened. I also have another blog that has very current, timely, informative articles that are posted daily, and that's under Michelle's Mortgage Minutes. BJ can send you a link to both of those so that you have that information as a resource for customers that get confused and frustrated. Does anybody have any questions in regards to those four common terms? That's a lot of information in a short period of time. Okay. The other common terms that you'll hear is the APR. Now, this is another one that confuses the heck out of people because they oftentimes confuse the APR for the interest rate. Just know the annual percentage rate is always going to be higher than the interest rate. The annual percentage rate was created in, I can't remember what year. It's been a long time, but it was created to allow people to shop from lender to lender and compare the APR. Because if someone is just comparing closing costs or they're just comparing interest rate, that won't be a fair comparison. The APR factors the closing costs that are there's specific APR or fees that are considered part of the APR calculation that is standard fees from lender to lender. And then interest rate, discount point, loan amount, and terms are all factors of the APR. So if someone was going to shop from lender to lender to compare which one has the best deal, they would be looking at the APR, not the interest rate. Very important information because everybody wants the best deal. Now, what you'll find is most reputable lenders will not vary that much when you're comparing APR to APR. Closing costs. Now, closing costs, technically, a lot of people say, they used closing costs as a generic term. And they will include the recurring items like taxes and insurance. But closing costs technically are just the items paid at closing to include non-recurring items and prepaids. Your prepaids would be that per diem interest that you're paying. The closing costs don't include your recurring items like HOA dues, flood insurance, homeowners insurance, and property taxes. But a lot of people will include those in that figure and just use that as a generic term. So if you wanted to be specific, you would be asking, do you mean closing costs with the non-recurring fees or the recurring fees included or just the non-recurring fees? Another term that you guys need to get really familiar with, and we as a branch and company-wide are looking towards helping you guys in that competitive market and issuing commitment letters versus pre-approval letters. A commitment letter is a commitment from the lender to close and fund that transaction. That means that the loan has been fully underwritten by a registered certified underwriter and a full approval has been issued minus property information. That is one step closer to closing and funding than a pre-approval letter. And that's the commitment letter that we're issuing, or you'll start seeing from us. If we can get the buyers to slow down in order for us to get their loans approved, we will be sending those loans into underwriting so you guys can close quicker and you can give the seller the confidence that, hey, the loan's already been fully underwritten. We're good to go. It's just as good as your cash offer.
A picture of me, which is fine with me.
Somebody just unmuted themselves.
Thank you, Dylan. I'm in, I think.
Hey, Ben, you're in. I can hear you.
Yeah, I'm on with your boy. Thank you, Dylan. Bye. He got me. He figured it out. Man, this is a mess. I guess he said yours had lost internet for a few minutes. I don't know if y'all can see me or not. I can't see me, and that's good.
Yeah, we've got a basement that's flooding and we've lost internet, but it's a sunny day outside. We're going to call it all good.
Oh, new swimming pool.
Yeah, come swim.
Wading pool, not good. Okay.
Yeah.
Hi, everybody.
Seller concessions. So the other thing that we're going to go over is what is considered a seller concession, but by definition, anything of value given by the seller to the buyer as part of the real estate transaction is a concession. I mean, just think of the word itself from a definition standpoint. So VA mortgages. Now, there's a couple, I'm going to go over the myths. Does anybody have any questions on the common terms? You guys all good? Okay. VA mortgages. So a veteran is the only one, I mean, the veteran has to be living in the house, and for VA financing to be used, it is an owner-occupied purchase transaction or refinance. You cannot use VA financing to help your kid get into a house if you're not going to be living in that house also. And your kid can't co-sign or co-borrow with you. It has to be your significant other. So VA is a little bit old-fashioned and funky in the way that they allow people to be on the application and the purpose of the loan. Now, you can be a reservist and National Guard. Just because you've only served for a short period of time does not disqualify you. It is determined by when you served and what was going on at the time that you served. So if someone says that they want to use their VA financing, the ding, 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 ding in your brain should be, well, get your DD 214 to the lender so they can see what your eligibility is. Okay, because that will determine how much they can borrow. There is oftentimes when we pull a certificate of eligibility that they had a home that they bought and sold from the 80s or the 70s or whatever that are still showing up. And so it shows that they don't have eligibility, and we need to get that cleared up. So the time to do that is in the very beginning of the process. Now, please know and understand that the agencies, VA being the case on a VA loan, has their own set of guidelines, and then you have lender guidelines on top of that determined by the lender's risk threshold. In our case, a 600 credit score is required, but just know some lenders require a 640. Some will go down to a 580 like we used to. After COVID, that changed for a lot of lenders. So whatever someone did 2 years ago, their risk threshold might have changed since then. So be sure to ask those questions. So VA is oftentimes used because of its flexibility in underwriting. So VA flexibility is in the debt to income calculations. It has some flexibility in terms of the information reported on the credit report. It has some flexibility in terms of the reserves that are required or lack of. But a lot of people use VA financing because of the zero down. Now, the one thing that you also need to know from an advantage standpoint on a VA transaction, if you have a piece of property that has 60 acres, land is priced like there's gold on it. And so you may have a really high sales price for this little farmhouse on this acreage. Jumbo financing is nearly impossible to do in our rural area. Jumbo lenders kind of went out of, they went into hiding during COVID and really haven't totally come out of hiding. So a jumbo transaction going VA is your best, easiest transaction if you find a VA buyer. I would do jumbo VA financing over any other loan program on that high acreage where you have a lot of value in the acreage, just because of the flexibility. So don't be scared of VA financing. I love VA loans. So if you've got a buyer that is making an offer going VA and you need someone to have a conversation with the seller's agent so that they treat that contract without prejudice, call me, because I'd love to have that conversation. I think our veterans deserve to be able to use their eligibility. They earned it. There's some flexibility, and it's not a difficult transaction. Now, a couple of things you need to know about VA, though, is the amount, and this is a conversation I'm not going to spend a whole lot of time on because you're not structuring the contracts this way right now, but just to store back in your mind for whenever the market does change. The calculations for the seller concessions are totally different with the VA than it is on the other loan programs. So what I will say is if you have a VA transaction and the loan amount is going to be under about 150, then chances are there's going to be some fees that either the lender or the seller has to cover. The lender may or may not be able to cover, so that needs to be a conversation that is had up front as part of the contract structure, rather than at closing when everybody's looking at a CD and all of a sudden there's fees on the seller side and people freak out. So if the sales price or the loan amount is, or if the loan amount is under 150, we need to be talking about, does the seller need to cover any costs, and if so, how much? Now, all VA transactions are going to require an appraisal. Can you guys still hear me?
Mm-hmm.
Okay.
Yes.
A call was coming in on my phone. Okay. All VA contracts are, transactions are going to require an appraisal. You will not get an appraisal waiver for a VA transaction. And the max loan amount is typically the same as what the max loan amount is on a conventional conforming transaction, which right now is $548,250. So $548,250 is the max loan amount. If you exceed that max loan amount, it's okay. There is jumbo VA financing. The down payment might be a little bit more than the zero, but it's still less than what it would be on a real jumbo. So it's still a great option. Does anybody have any questions on VA? The only thing that I want to add, and this is true for all seller concession conversations, remember, anything of value from the seller to the buyer is considered a concession, which is why your lenders, the underwriters, freak out whenever you guys have a non-realty item addendum that has a whole long list of all of these things that the seller has given to the buyer for zero. Number one, those things have value. Number two, it's going to be considered a concession, or could be considered a concession. So if you have things that the seller is leaving behind for the buyer, I would call and talk to your lender about how that should be handled, because I'm not suggesting you guys have any documentation outside of the contract, but it does need to be understood how that's going to be viewed from an underwriter's point of view based on the loan program. FHA financing. So FHA, again, is for owner occupied. Now, remember, Fair Housing Act was put into play after the Second War, and it was put into effect to help home ownership, specifically those families looking to purchase. So it is not just for first-time homebuyers, but a lot of people have that perception that FHA is for first-time homebuyers. A lot of people will call and say, "Hey, I'm looking for that first-time homebuyer program through FHA." FHA doesn't have a specific first-time homebuyer program. Now, we do use a lot of grants and bonds using FHA financing, but it is not. There is not a specific program for first-time homebuyers within FHA. However, the reason I think that a lot of people think that way about it is because you typically can't have two FHA loans at one time. With VA, you can have two VA loans at one time. So if you had a house that you bought VA, zero down, lived in it for 3 years, decide to move and buy another house using VA, keep this house as a rental property, you could use VA financing again. The down payment would be determined by how much of your eligibility is remaining, but you can use VA multiple times. FHA, you can use multiple times, but you can't necessarily retain that current FHA loan and buy another house through FHA financing. There are some ands, ifs, or buts. If the house no longer serves your needs and you can prove it, you have a 3-bedroom house and it was just you and your 2 kids, and now all of a sudden you marry someone that's got 6 kids, that house no longer is big enough for all of the children to safely sleep in their own rooms or even doubling them up. So there may be some provisions in which you could buy another house FHA across town, but they need to ask those questions to the lender because the ands, ifs, or buts are very specific. Now there's some other situations where if you got a job transfer and you have a house FHA and you're going to retain that house, like right now, trying to do a simultaneous close is nearly impossible. So FHA financing may be the only way they could purchase that house without selling their house because their equity is in their house and they don't have a bunch of money in their bank account. So we have to look at FHA financing as an option because of limited down payment. And if that's the case, then we can look at FHA financing and look at the ands, ifs, or buts and see if we're going to be able to do a second FHA loan while they return their current FHA loan. But don't assume that it's going to be okay. The other thing that's a little bit different about FHA than VA or conventional is there is maximum loan amounts that are based on the county. So you have to know what county they're looking in. And if that changes, then you need to talk to the lender about the changes in the county. Grayson and Fannin income limit or maximum limits are the same, so you're good there. But if you've got someone that was looking at Denton County and they end up in Gunner instead, or they were looking at Collin and they end up in Gunner, those are 2 different counties and the limits are drastically different. So pay attention if you've got a FHA buyer in what county properties you're showing, because it could change the pre-approval. A couple of other reasons that we use FHA financing is not just for the down payment, but there's a lot of flexibility in the debt to income calculations. There's some flexibility in the credit history. There is also some quirkiness about it all as far as how we have to count any disputed accounts, collection accounts, and things like that. So there are times that FHA is harder on the credit than a conventional loan. And if that's the case, we'll interchange them both. But if you see where a lender has said, based on FHA, they can go up to 275, but if they were going conventional, they could go up to 3.25. Some of that might be because you have non-purchasing spouse debt that you're having to count. There may be some differences in the cumulative payment that we're having to count on collections for FHA that you wouldn't have to count on conventional. There's a reason for that. And yes, it can be that drastically different. I'm looking over this list to make sure I cover all of the highlights as it applies to what we're dealing with right now. Oh, I knew there was something. One of the biggest fears that people have right now in this market with accepting an FHA offer versus a conventional offer is the mandatory clause that has to be signed by the buyer, well, all parties, including you, that states that the buyer does not have to pay more than the appraised value. It says the buyer doesn't have to pay. Same thing, the mandatory clause goes FHA or VA. It doesn't mean that the buyer can't choose to pay. It just says they don't have to. So how you guys address that in the contract, if you have a buyer that is willing to pay over appraised value by X number of dollars, you need to talk to your broker about how to write that contract. But FHA is not saying that we can't fund that transaction. What they're saying is the buyer does have the option to opt out of the contract, unless you guys already address that in another part of the contract, stating that the buyer is okay with paying X number of dollars over the contract price. Again, it's really important you pick up the phone, talk to the lender on every one of the offers that your seller is considering, and make sure the buyer has the funds available to pay X number of dollars over the list price. I suggested to an agent who had that question this morning that they get it in writing based on these scenarios the buyer would still be okay with the transaction, and it was the sales price of this, appraised value of this, sales price of this, appraised value of this. And make sure you guys are okay with that. Cover your basis, but ask those questions and don't be scared to ask the lender those questions, because it's part of your fiduciary responsibility to make sure that that transaction is going to close and fund as contract written. I do have a sheet that I will send to you guys that has the property conditions that you need to be looking for on an FHA transaction, USDA, and VA. The form itself or the flyer itself says, will your property pass an FHA inspection or appraisal? But the guidelines are basically the same for all three of those loan programs. So if you're showing a house and the buyer is using FHA financing, I would have this checklist, even if it means doing a screenshot, putting it in a folder in your phone under photos, and have some of these charts available at your fingertips. Because as you're walking through the property, you can be going through and making sure that there shouldn't be any issues with the condition of the property if you were to do an FHA contract. That way too, if the seller has any questions and says, we're not negotiating an FHA contract because I'm concerned about these conditions, you can send them this checklist too and say, hey, listen, I understand your concerns, but according to this checklist, it looks like it's going to be okay. Can you tell me what you're concerned about? And if you have a screenshot of some of the property conditions that you're concerned about, send them to me. I don't mind sending them to an appraiser and seeing, what I typically do is send it to several appraisers and get their opinion, and I'll give you their opinion. That doesn't mean that the appraiser that gets chosen for your property might have a different opinion, but I think that you preempt any potential problems by having that conversation up front and running it through and at least getting a consensus. And I don't mind doing that for you guys. Even if we're not the lender on the transaction, I can always give you my opinion. My opinion may not matter to another lender, but I've always got an opinion. So I have got a chart in the slides that I will show, that you guys will see, that is a comparison of FHA versus conventional, because those are the two comparisons that you're going to see most often, because most people will qualify for one versus the other. But some of the biggest differences is in the way the calculations are figured for income, the way the calculations are calculated for the payments on debts, so the debt to income, the way the credit history is viewed is different from one program to the other. The credit score requirements are going to be different. Most lenders you'll see will require at least a 620 on a conventional loan. That's Fannie and Freddie's suggested credit score requirement or threshold. On an FHA loan, I've seen it as low as 560 on FHA and VA. I haven't seen that in the last year to 18 months, but I've seen it in the past. Guild has always been at no less than 580. Right now, the risk threshold is 600. The flexibility, remember on a conventional loan, as we'll talk about in just a second, you can do a conventional loan with as little as 3% down. Now, there are some caveats in that we'll talk about that as well. FHA is for owner occupied. So please know and understand that. But some other reasons that you might look at FHA financing versus a conventional financing is just the timing on foreclosures and bankruptcies are a little bit more lenient on FHA and VA than they are on a conventional loan. Same thing with USDA. I don't have any slides for USDA, but just know FHA and USDA are real similar in their underwriting guidelines. USDA has a different approval system that we have to work with. And there's some aspects that are a little bit more finicky, but it's a fabulous program. It's zero down. There are income limits, but they're pretty generous income limits for our area. There are pockets of Sherman and Denison in town, believe it or not, that qualify for USDA financing, but most of your little towns in our area do qualify for USDA financing. So that is another option that we're looking at when someone is limited on their funds. The one thing that you need to keep in mind on USDA financing is they do not give value to ancillary structures. So if you have barns, shops, swimming pools, you're not going to get value for those on the appraisal. So just know that and be sure your lender is aware that there are those structures on there, because that could affect the values. Anybody have any questions on FHA or the brief little cover of USDA? Hey, any of my USDA folks that want to chime in on USDA financing, feel free.
So on the reserves for FHA, do you, off the top of your head, do you know an estimated guess on what somebody would have to have in their reserves if they were going to put down on a house of anywhere in the range of 200,000?
If someone is borderline on debt, say they have marginal credit scores, their debt to income is totally maxed out. So let's just say, ideally we're around 43 to 44% debt to income. Let's just say we've got this at 56, and on marginal credit, 56% debt to income. Typically, FHA is going to want to see a minimum of 3 months of house payment in their bank account left over after the purchase of the house.
Sweet.
So a lot of times, if we're not getting an approval, we will play around with the assets to see what amount of money they need in their account. Now, sometimes it's the source of the reserves that matter too. So you can't get a gift from a family member. So say, mom and dad are helping and they're writing a $30,000 cashier's check to make this first home happen. But the reserves can't come from a gift. Mom and dad can't give extra money and put it in their bank account to cover the reserves. On a conventional loan, the things that you need to keep in mind on conventional loan, yes, you can do 3% financing. So what we're seeing sometimes is that if a value comes in short, then we're changing the loan to value to a 3% down loan to value. So they've got more cash available to write a check for the difference, for the appraisal gap, right? And so in that scenario, we have to make sure that they are either first-time home buyers. One of the two borrowers has to be a first-time home buyer. First-time home buyer defined by not owned a home in the last 3 years. And then, or they are under the income limits. It's either or. There's two different programs. One's Fannie, one's Freddie. So we'll run it both ways. If they qualify for some of the My Community or some of the community programs, then there'll be a reduction in the mortgage insurance and they won't pay a higher interest rate for less down payment. So there's a couple of different ways for us to figure this. I hope you guys are starting to understand why we can't just give you guys a 15-minute willy-nilly pre-approval letter, because there's so many things that we have to consider and go through when we're comparing FHA versus VA or FHA versus conventional, or whenever you guys call us at the last minute, go, oh my gosh, I just wrote this contract conventional and I just noticed your pre-approval letter said FHA. It is not just a matter of changing a couple of screens in the system. We totally have to rework the loan, rework the income, rework the assets, rework the liabilities, how we're counting the payments based on the liabilities. It is a total rework on all of these different loan programs. Now, with a conventional loan, unlike FHA, if I have someone with no credit scores, or the information on the credit report is incorrect and I can prove it's incorrect, I can request an underwriter do a manual decision overriding the system to approve that loan. And I feel like at that point, I'm like their attorney building this case for them on why the underwriter should approve their loan. I love those loans because I like arguing with people, but I like proving myself right. But in Beverly, I've got Beverly on this call, and I can't tell you how many times Beverly and I have done these transactions in the last 25 years where we've just really worked hard to build a case for someone for getting that loan approved. FHA gives us that flexibility. A conventional loan, you basically have to have an underwriting, an automated underwritten you have to have an AUS in the file, automated underwriting system approval. Now, conventional is what we use for your vacation homes. So if someone already has a house in Dallas, they're buying a house at the lake, we're going to use conventional 10% down for a vacation home. You also are using your Fannie Mae, Freddie Mac conventional loan financing for your rental properties. And that is something I want to touch on in just a few minutes too, because we have some major changes right now in the pricing of investment property and second homes, because the Treasury is concerned with the market being flooded with those transactions. And so the cap is 7%. There's a 7% rule in place where the 7% of the loans that we're selling or backed by Fannie or Freddie cannot be no greater than 7% is where they want everybody to live in terms of the mix of loans or loan purpose. So you'll see that lenders have priced those loans up. So it's more expensive for an investor right now to purchase property than it has been in the past. We're working as an industry to make some changes in that area, but you will have investors paying a little bit higher interest rate or higher points than they would have just 6 months ago for that same property if you were comparing apples to apples with the rates themselves. But typically on an investor loan, your down payment is, you'll see 25% as an investor loan. You can do the loan with less, but the points are so high that you might as well write a check for the down payment at the 25%. A vacation home, like I said, is 10% down. You can, as a homeowner occupying the property, have a down payment as little as 3%. But the concessions, which we're fixing to go over in just a few minutes, drastically change based on the amount of down payment from your buyer. So again, you guys aren't seeing sellers' concessions right now, but I want you, while you're taking notes, to know when someone sends over a contract and they're asking the seller to pay a bunch of money, what is and is not allowed based on the loan program and the amount of down payment. But before we go over that, I just want to cover a couple of other things. Escrows are always going to be required on FHA, VA, and a conventional loan with less than 20% equity. So escrows for your taxes and insurance are always going to be included in the payment on including USDA. So when you're doing a conventional loan, there is that flexibility to take care of your own taxes and insurance. Sometimes that's a big deal for your buyers. Now, the other thing that we're seeing that is a little bit different with conventional than the other programs, people are having to retain their houses. So they can't do simultaneous close. You're not writing contingency offers right now. So they're having to buy the house, retaining their current house. They sell their house. They have a ton of equity in their house, and they decide that they want to put that equity towards the new loan on the home they just purchased. When they do that, as long as the principal reduction is at least $10,000, right, BJ, 10, then you can request a recast of your payments, where we're literally refiguring what your payment is based on the new balance after this large principal reduction. That is very attractive to a lot of sellers right now, because they are having to retain their property, their equities in their house, and they're wanting to put it towards the new house once they purchase the new house. Or, I mean, once they sell their house. We can also request the removal of their mortgage insurance. So those, the removal of the mortgage insurance is a little bit different process. That is going to be lender specific. BJ and I know what Guild will allow, but every lender is going to be different in how they, what the process is for the request of the removal of mortgage insurance. That could be a class in itself, how we use mortgage insurance to help people into these homes. And I won't go over all the details of that right now. But the down payment, I mean, yeah, the down payment determines the amount of concessions a seller can pay for a buyer on a conventional loan. So if the buyer is putting less than 10% down, then your concessions are capped at 3% of the loan amount. If the if the down payment is 10%, between 10 and 20%, it's 6%. And then if they've got greater than 20% down payment and it's an owner-occupied transaction, then the down payment can cover all of the closing cost, taxes, and insurance. So just know and understand, but remember, seller concessions is not just the closing costs covered by the seller. It is anything of value that the seller is providing to the buyer to facilitate the transaction. So that could include carpet, decorating allowance, furniture, farm equipment.
Michelle, what was it was capped at 3%, the down payment?
Ask the question again. After 3%, you cut out.
If the concessions are capped at 3%, how much was the down payment?
Anything under 10%. And then 10% or greater, 10 to 20% is 6%. So 10 to 20% down payment is 6%. Yep. Paperwork for all of these transactions are basically the same. We've got to have income documentation that has year-to-date earnings on it broken out, which sometimes requires that we have to get documentation from the lender because the pay stubs may or may not have the breakout of the income, so we can do the averages. W-2s are oftentimes required. Tax returns are required on self-employed. You guys, right now, the biggest struggle for these poor self-employed borrowers is the paperwork is intensive. The scrutiny is high, and it is a real hassle right now as a self-employed borrower to get a mortgage loan. So please be empathetic to their frustration. They not only have to provide 2 years tax returns of personal and business, their K-1s if applicable. They also have to provide a P&L for last year if they haven't filed taxes. If it's an unaudited P&L, and an audited P&L right now, trying to get an audited P&L from a CPA is not going to happen. And if it did, it would cost multiple thousands of dollars, even in a non-busy tax season. So the option is to provide 3 months bank statements for the business account that shows the activities that we can align with the P&L. Then they also have to do the same thing for 2021 year to date. Those were COVID overlays, industry-wide, not lender specific, that we have heard are probably going to stick and not go away. So please know and understand the frustrations that your self-employed borrowers might have through the loan process. And don't wait to the last minute to get them to get their application turned in and their paperwork turned in. And we can't begin any of the calculations until we have all of the things I just mentioned. So that is not a 24-hour pre-approval letter unless they have provided everything. Because remember, a lender that is thorough up front is a lender that's going to close and fund that transaction without problems in the end. So you either make it hard up front and get everything taken care of, I's dotted, T's crossed, and make sure that you preempt any problem that you see might arise, or the problems happen at the end. I would rather make it hard up front and prepare your buyers for the fact that pre-approvals are required. The lender is going to be called and asked if the pre-approval was based on documentation received, calculations ran, and all of the scenarios reviewed. You guys have got to be comfortable with asking those questions and telling the buyers that is going to be expected of them in this environment that we're in, so that they get all of this done up front. As you can tell, it is not quick and easy to get a pre-approval letter issued, because all of these things have to be considered for all of the different loan programs. So I'm going to provide some resources for you guys that have some charts of what down payments are required for the different loan programs, what these, which ones are for first-time home buyers, which ones are not. You'll have all of that available to you guys. It will spell out those concessions. So if you don't have good notes on that, those are there. If there's anything that we did not send you that you feel would be helpful for you having this conversation with the buyers and the sellers, or for you to feel comfortable in asking those questions of the lender, then just say, hey, I'm looking for this material. Chances are we already have it. I just did not want to overload you with documentation and charts and lists. But the one thing that everybody needs to know and understand is that it is super important. Once they're pre-approved, that does not mean that they're free to go change jobs or go buy things or charge up their credit cards or have, their credit ran by people, or go sell some farm equipment, put large deposits into their bank account as cash. Once they're pre-approved, they're grounded. That's what I tell people all the time. You're grounded. You cannot go do anything that would change your credit or your finances in any way until you are closed, funded, and have moved into your home. Because we are going to pull a credit report within 5 days of closing. And we are going to look at the new balances on any accounts. We are going to look at all of the inquiries. We are going to look at any new debts. We're also going to be verifying the employment. We have to have verification of employment within 3 days. All of those things are going to be looked at, not just at the time of pre-approval, but at the very end. The other thing that people need to know and understand is if it takes them 6 months to find a house, that pre-approval is typically only good for 90 days. So it's frustrating right now to get under contract. So we need to all do what we can to structure a contract that has a successful ending and get them in these homes as quickly as we can without them getting frustrated or distracted. Because the longer we let them go, the more tempted they're going to be to say, oh, forget it. I'm just going to go buy a car instead. Or just forget it. I'm going to go do X, Y, Z. And then the perfect house is available. And now they don't qualify. So your lenders right now are all doing the best they can to put people in the best position for winning the contract. It requires a lot of conversation between us, you guys, and that buyer to structure something that's going to work, but fully understand the different loan programs and how they affect that transaction and that pre-approval. Does anybody have any questions or anything to add? Is that a lot of information in a short period of time?
Michelle, I was very intrigued with the information that you shared with us about the self-employment information. I'm working with a lot of self-employed clients right now, and we're just kind of in the look and see and let's wait situation right now. So,
well, and Beverly, it's frustrating. And, we're running a lot of scenarios of, because your buyers do get frustrated or they don't want to go through the hassle. So they're like, well, we'll just wait and see how things are going to shake out. We have put together what we call a cost of waiting. So based on the average appreciation for the house in that zip code, in that price range, what is the average appreciation? And that information needs to come from you guys so that we're not making up numbers. I mean, I have a pretty good idea and I'm keeping an eye on the market closely, but also the cost of waiting is not just in the increase in the cost of the real estate, but it's also in the interest rate. So we have a program that we just put that information in and just see, is it really, what's it going to cost? What is that cost of waiting? And does it outweigh the frustration of buying now? And that's not anything I can't make that decision for someone, but I can present the information to them to help them make that decision. And so we have the ability to do that. If anybody needs that, I'm going to need enough information from you to put that together for them. The other thing that we're doing a lot of too is there's another analysis that we use. There's a fantastic program that we call through Mortgage Coach. We put together total cost analysis. Another scenario that we're running a lot is just running those scenarios up front. If you had to pay X number of dollars for this house, and the house is only going to appraise for possibly this amount, maybe this amount, and hopefully not, but this is the worst case scenario amount, run all of those scenarios and make sure that they're still okay. Not just from a qualifying standpoint, but from a mental and emotional standpoint, and running all of those up front so that when the appraisal comes back, you don't have the emotional meltdowns that result in people just canceling contracts because they weren't prepared. Let's prepare them and hit them between the eyes right now with reality and what could happen, and make them okay with that. And if they're okay with worst case scenario, then if it's, kind of worst case scenario, but not the worst of the worst case scenario, then they don't have those emotional meltdowns that result in a canceled transaction. So, we're, any other ideas, or you see something that somebody else is doing to help us manage relationships and emotions right now, at the same time being as creative as possible with the numbers to help people into these homes, give us those ideas. None of us get paid until the transaction funds. Not that it's all about the money, but heck, this is a lot of work for free. So,
well, if it doesn't close, you could go ahead and pay us anyway because you're so nice.
I could. I probably won't, but I could. Now I got flooded basements and stuff like that to take care of. Actually, I think our sump pump just decided that it didn't work anymore. It's retired. The joys. Let's help more people own homes. You want to?
Yes.
All right. If y'all need anything at all, y'all know we just want to be a resource to you guys. I know I can't be the lender on every one of your transactions. That's perfectly okay. I'd love to, but I also understand. But the purpose of all this is just bringing you guys some knowledge, and you guys can use the knowledge for your own experience. And just know that we're a resource for you.
Great.
So would you tell everyone to please check their chat? Some of these I don't have last names or email addresses. I want to send them the presentation and all that good stuff. So
you guys, so email addresses are super important. You guys make sure that BJ has her email address. If we hop off before you get it into chat, is Kirkpatrick, so KIRKPATRICK at guildmortgage.net. Please give us an email, send her an email to make sure that we have your correct email address so we can get all of this great information to you. All right. Y'all have a wonderful day. Yeah.
Earlier you were talking about VA loans. A couple of years ago, I took a VLBS course. You know what that is? A veteran landlord specialist. Do you ever do those, or are those only good for 1 year when you take them? For bragging rights, basically.
Yeah, I don't know. I haven't talked to Mike in a while about that. We talked about having him back up here for some more classes, because that is a fantastic program. So what Ben's talking about is the Texas Veterans Landlord Program. It is like a grant or a bond. It's kind of the reverse, because what you're doing is you're using that program to lower the interest rate. You're not using it for funds for closing. So there's a cost associated with using the program. However, most of the time, the benefit outweighs the cost. Again, we just need to run that scenario, but let's just say mortgage rates today on a VA, a straight VA was 3 1/4, 3 1/8. They could choose to use the Texas Veterans Land Board to lower that rate additionally. So let's just say that you decided to, the rates are posted daily. You can't lock in the rate on the Texas Veterans Land Board until you have the loan underwritten and you're ready to close. So you're hoping to catch that rate, at a really low rate whenever you can lock in. But let's just say they're posting a 2.75% rate. So if you were to use that program, you would have that 2.75% rate. However, they're going to charge you 2 points, one in origination, one in discount for using that program. So sometimes it's better, you're better off just buying the rate down yourself, or maybe you're not going to be in the house long enough for it to make it worth your while. But that's an option to look at. We just put that on the total cost analysis and run the numbers and see, what's your break even, and does it make sense to use that program? But the other way that the Texas Veterans Land Program can be used, or Land Board program can be used, is to purchase land. If you're a Texas veteran, meaning that you live in Texas right now and you served in the military, you could use that for purchasing land, and the down payment is as little as 10%. So it's a great program to use as a veteran to purchase land, and they don't have all of the other fees associated with that. So it's just a great program. And there is fixed rate versus balloon on that program, and the AMP schedule is typically better than what you could get at a local bank. So it's a great option. I'm glad you brought that up. I meant to mention that earlier. But you don't have to just use the TXVLB on VA. You can use it for conventional and FHA too.
Well, right now it's the point is moot. No sellers that I know are even offering VA or FHA or any of the government backed stuff, because the conventional and cash buyers are beating them to death. So that's a
I know
problem.
we're dealing with that. It is. There is. It's definitely a frustration for those that need a home, not just want a home.
It's tough on them. Can't blame the sellers.
No, but I have been reaching out to the builders, because we're going to have to count on the builders to help this inventory situation. But of course they have their own challenges. It's not like we can tell them, hey, go build 100 houses. That's not so easy either. So if you guys have any chunks of land that you're about to list that might be good for developing, I've been trying, our builders are good at hiding, and they stay in their little underground tunnel. Actually, they're buried under piles of lumber right now. That is very expensive. But my point is, I've been trying to reach out to these builders to make them aware of some opportunities for developing. If you know any chunks of land that would be good to develop, I can either give you my builder list, or you give me some information, I'll blast it out to them. I'm also trying to find out what all they've got building that they're not telling anybody about, so that you guys have information on that as well. So I'll continue to try to be a resource of that. If you're not already part of the Facebook, Your Realtor Community Facebook group that I have, it is a secret group, so it's really hard to find. Reach out and say, no, I'm not part of that, but I want to be, because that's where I give a lot of this information out. But any comments that you guys put in that is not seen by anybody else. So it's just our own little network community where we can communicate in private. All right. Well, you guys have a wonderful day. Reach out to us if you have any questions or need anything.